We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Mike from Parallel Systems YouTube channel. Mike, how are you today? Great to have you back.
Yeah, you too, Tom, and thanks for the invite as always. I appreciate it.
You know, it's great to be able to have the chats that you and I do. I think we just spent an hour chatting before the recording, which is, not necessarily out of the ordinary for me, but, you and I have spoken quite a bit. And I think we see the world in a lot of the same way. And I think we'll get to that through this episode. But I'd like to start by asking you why you think that so much of the world right now is dependent upon the US and how it moves through and maybe recovers or not from this monetary and fiscal situation right now.
Yeah, I think with the US being the prime country in the world in terms of the dollar, it's the global reserve currency. It's also the main military might. And I think you could also say it's probably the social and cultural driver in the world as well. Most of the media is in English and it's delivered through American or Anglo-American news outlets. And of course, the internet's nearly all in English. So really, it is the hegemon. It's the world's only hegemon. It's the only one we've ever had. We have had empires like the Roman Empire, but nothing like what we've seen today with all of the military bases and basically spanning the entire globe, or I don't know if I should call it a globe, Tom. Some people might take offense to that one. We'll call it a globe. So we've never had anything like this. And I think as you get towards the end of these chapters in history where you have such a dominant power, things can get really messy. And therefore, the existing power will have to go to more extreme lengths to assert itself upon the rest of the world. And if it can't do that financially, if it can't do that through fiscal dominance and financial warfare, then it can span out into kinetic warfare and cyber warfare. And I would say psychological operations too, which are used to not just control of the nations, but also the population of your own country. Because, of course, as you get towards the end of a financial system, if that's your currency as well, then you're going to have to start looting your own citizens more and more, and they're going to suffer at the expense of the I don't want to say the emperor, but you could say the emperor. The US doesn't have an emperor, but I would argue that there is an oligarchy within every nation. You've got the political structures that you see, and then you've got this shadow oligarchy who have a substantial amount of influence, and maybe more so than the president themselves. And I think listeners probably would accept that. I don't think anyone believes Joe Biden, for example, had much power in the system, but you could argue Donald Trump too. It's, we oscillate from left to right in America, but ultimately I think there's other drivers, corporate drivers as well, big financial powers that of course fund the different diplomats and politicians. So that's why America is so important. And I think if America doesn't come out of this one and we do enter a global slowdown and that turns into a recession, I don't think the world can handle a recession. It's kind of crazy that we live in a world where a slowdown could actually bring down the entire pack of cards that everything else is built upon. Just a slowdown, just people not going out to buy more crap that they probably don't need, not going out to eat as much, not going out to spend as much. And maybe we can talk about that a little bit later if we want to look at recession indicators and consumption, which is going down. So I think for me, what I would say is the big risk is not just that we would have some kind of economic depression globally. It would be the knock-on consequences of that with the US as a hegemon that has its back against the wall. And when I say US, I think we should incorporate everything that I said before, like the people who actually use the US as their tools for extraction, whether that's going to different continents to get cheap resources that it can sell to European and international markets, or I think we just have to be very careful not to imagine the US as this nation and that's all it is. It's built up of many different power structures. And yeah, if the US goes into a major financial crisis, or there's a big global slowdown, and that starts to tip the power balance much further to the east, which is already happening. That's a long-term trend, but it could speed up substantially. Then I think we see an expansion of war. I think we are already seeing the beginnings of global conflict and what's happening with Ukraine and Russia, and now in the Middle East. Of course, we've got the Taiwan conflict that's bubbling away. I think all of that could just ignite in a second. It's like petrol that's soaking the entire world right now, and it just takes a spark. And I think the financial spark could be it. So there's many reasons to be worried about what's happening financially and how that will bleed out into the world. Of course, we've got other narratives, civil war narrative. Ray Dalio is saying there's a 50% chance of civil war in the US. And yes, it's more divided than it's ever been. But I also think there's a lot of manipulation of that narrative. Like I don't believe most Americans are going to go to war with one another. I think there's going to be very small people in the margins, very small groups of people, in the margins that may be willing to go out and actually have conflict. But most people, the conflict exists online. And of course, we're seeing massive censorship now across the world in terms of Twitter and Telegram. So you can pick through that, Tom. There's a lot of narratives there that we could maybe get into more deeply.
Absolutely. There's always, a lot to unpack. But I think one of the important parts of what you said that I wanted to pick up on is looking at the incentives of these control structures rather than the figurehead, right? Focusing on this one person as, in some ways, a lot of people are seeing certain people as, let's say, a messiah to save a particular country, to save a financial system, whatever it is. And take a step back and realize, as you said, that these are very likely just figureheads. And instead of becoming overly emotional and tied to an outcome of a particular election, just realize the general direction of where things are headed.
Yeah, and you could take this back, let's say 50 years, maybe 60 years, and see that we have just been on a never-ending train track. There has been no divergence. We've been on this same path. Currency debasement, of course, is a key part of that, but also this consumption and extraction-based mindset. And as you get towards the end of any system, you start to see certain features crop up and you start to see certain things pushed in society. So right now, they are actively seeking to divide people as much as possible to make them easier to control. We're seeing narcissism en masse, and that's been pushed as well, because I think it makes people much more focused on retaining what they've got in the same system and not looking for something new. It keeps people kind of trapped into this mindset of greed and living the American dream, which we always told that we could have in the West. And I mean, if you look at the US fiscal situation, you've got US debt now at 35 trillion. And if you look at the legacy of how we got to that amount, does it really matter who was in power? Like, was there a president over the last decade, whether you're a big fan of the Republicans or the Democrats, was there anybody that actually did anything to solve that? I think under Donald Trump, his first presidency, it was a 40% increase. That was 8.18 trillion. And then Biden was 6.5 trillion, which is a 24% increase on top of that. And I don't think whoever gets into the White House, it's going to change that situation. In fact, it's only going to exacerbate it. And if you look at the wealth that had been transferred during those presidencies, during Donald Trump's presidency, the total wealth of billionaires rose from 5 trillion to 13 trillion. So, you can look at things from different perspectives. Some people see Donald Trump as a hero who's going to come and save the economy, is going to come and save the world, and is going to take us back to something more wholesome, take us back to something like the 1950s. But I just don't see that. I think everyone has a role to play in this. And the role isn't to make our lives better. It's not to support the everyday man and woman. It's not to bring about prosperity for us. First and foremost, they've got wealthy backers that they have to kick back to. And that's why we're seeing these massive wealth transfers enacted over and over again. And sure, you can say, well, someone's the lesser of two evils. That's a fair position. Okay, someone's the lesser of two evils. But if you zoom out and look back at that 10,000 foot view and the historical track that we've been on, like I said, it is like a train track. Nothing's really changing, Tom. It's getting worse. And that's why I think we're getting to this point now as well, where they need to enact a lot more authoritarian and social controls. And sometimes that's being done by the state, but I would argue a lot of that's being done by the private sector too. And it's actually being embraced by people as well because it's being packaged in the right way. You know, a lot of these things are coming from, for example, Silicon Valley and different kind of technologies that we're told are being used for freedom. That's going to be used to enhance our lives. But actually, the more we hook ourselves up to the technological systems that they're creating, the more surveilled we are and the more our lives become things that can be manipulated by the state. So I'm not so sure on that either. I'm not so sure that there is somebody out there working for us and the little guy and trying to get this ship back on course. It's not happening, in my opinion. So therefore, that puts the onus back onto us to take real action in our lives and maybe emergency evasive action if we've been people that have maybe we've done well in the old system. But I think you have to recognize sometimes when things are coming to an end. And as I said, we are now seeing all of the hallmarks of a system that's in terminal decline. And I don't want to be somebody that sounds like, you know, always predicting catastrophe. But if you look around at how things have played out over the last 4 years, you will have to say some of these things really are unprecedented. It's a word that's bandied around a lot, but locking down entire economies, closing down businesses, wealth transfers of trillions from the poorest to the richest. These are the kind of things that you see at the end of a system. It's when all of the elites of the old system, they loot it. They loot it and take whatever they can get, and then they take it with them to the new system. Now, if you look at it from that perspective, you can understand why America's actually not the important part here, because the elites that gained control in the old system, they can move. They've got families that can move to, you know, Saudi Arabia or to China or wherever they want to live. So what we're going to see, I think, as the system comes to its logical conclusion, which is some kind of reset, I think what we're going to see is a lot more looting going on. And I think it's so corrupt at this stage, it's very unlikely you're going to get a hero comes along and manages to reform that. And I think if someone tried, well, there'd be a marked man. And I mean, and then that feeds into the assassination attempt narrative, which let's not get into that. But yeah, ultimately, I don't think that either candidate's going to be making the kind of changes that we would like to see. So therefore, yeah, you got to look back on how we can manage our wealth going through this one, how gold can help us protect our wealth, and ultimately, yeah, maybe redesign our lives to fit a different narrative to the one that we're being given.
Mm-hmm. Yeah, I like kind of going back to something, as you were saying, this idea of the doubling or the compounding of this debt over the last, let's say, 8 years. Obviously, in preparation for today, I read one of your newsletters, and you framed it, I think, perfectly by talking about it as the game of pass the debt parcel. I think that's a perfect way to frame this idea. And again, kind of to sit back objectively and understand the numbers and the timing of those numbers is important, rather than just rooting for and being solely focused on one team winning versus the other. We have to realize that in a lot of ways, these teams are one and the same. This two-party system in the US is a broken system, and we can't necessarily expect, you know, a messianic figure to completely upend the system as it has been laid out.
Yeah, I agree with everything that you said, Tom. And if you look at the US now in terms of its debt levels and the interest that it's going to pay on that, it's 892 billion in net interest payments, and that's for this year. But that's only going to go up. There's no retreat from that. So if you think about how that's going to impact the everyday American and their families and their retirement, and of course, there's so many benefits that are laid out to the Americans that are just never going to be fulfilled. And it's the same across Europe as well. If you look at the funding of pensions in Europe, it's catastrophically low. It's something like 10 to 20% funded. Mm-hmm. And there's no way to fix that unless they're going to continue what they've already done, which is to debase the currencies. And I don't actually see anyone calling for that. What we actually see in the media is a lot of people arguing about gender politics, which I think is very useful. It's useful to have a world that's obsessed with identity politics, because none of that actually matters to the people who are more bothered about extracting wealth and looting the everyday man and woman. Like, they would love for us to just sit there and argue about identity politics. And of course, some of that's really important because it does affect our lives. I'm not suggesting otherwise, but I think there's almost like two systems at play. There's the system that we are given in the mainstream media that we are told to fire our arrows at, but the real system is actually just operating and carrying on regardless, and nobody's really focusing on that. Of course, we do speak about it in our respective channels, but even then, there's a lot of people that I speak to through what I do, and they are obsessed with, what's happening in the elections and who's going to win and consuming all the content around it. And I'm just not sure if that's useful at this point. I think for me personally, I know it's not. So I try to focus on what is actually happening. Mm-hmm. And I think looking back at what happened in 2020 is really instructive at how they had to deal with the slowdown that was happening going into the end of the year. Because remember, they were cutting rates going into the end of 2019. And we had BlackRock in August of 2019 at Jackson Hole at the annual summit for the central bankers. They actually released their paper, which was talking about what they're going to have to do in the next crisis. It was called From Unconventional Monetary Policy to Unprecedented Policy Coordination. And in that, they actually spoke about what they was going to do during the next global downturn. They said that the conventional monetary tools are no longer going to be viable because they'd exhausted them. So they were essentially going to have to go to this helicopter spending, where they was just going to print money and drop it in the accounts of people. Now, like I said, most of that money went to the billionaire class, a substantial amount, but people also did get money put in their bank accounts through stimmy checks. They forced people to not go into work. Many businesses failed, but it did lead to this massive increase in excess savings. And that was what they intentionally tried to do, in my opinion, to create the illusion over the subsequent years, once they released that liquidity back into the economy, that there was growth and that everything was fine. But it wasn't. It was, of course, it was paid for with massive inflation, which didn't come till afterwards. And now we're dealing with those consequences. But when they delivered all this money to people and it went into the economy, what did it do? Well, first and foremost, it led to the illusion of growth in the economy. It led to this flood of money going into the system. And you saw this in things like, for example, luxury watches. During 2021 and 2022, there was luxury watches that were selling for 30-40% over their retail price, because with a watch, usually you have to wait a year for it. So you get a watch on the gray market, which is where somebody gets it new and then just resells it. And there was a 30-40% uplift. And it led to this huge spike in, people buying boats, for example. I actually lived on a boat and I sold my boat in 2020, just after the first lockdowns. And I'd been watching the entire boatyard. Every boat that was put up for sale was sold like that. Now, there's some jokes about boats. They're a great adventure to go on, but they're also an extremely terrible hobby to have because they're they cost a lot of money. Unless you're living on it like I was, that's a little bit different because that's your home. But for people who were just going out and buying these things, it's because they had all of this excess money sat in their bank accounts. It was actually 2.1 trillion is what it peaked at in March. I think it peaked in 2022 at 2.1 trillion. But as of March this year, all of that money's gone. And like I said, we saw all this excess spending on these luxury items. But today, if you look at those same areas, they're not selling. If you look at, for example, Rolex watches, or there's an index that Morgan Stanley do. It's called I'm trying to think of the name. It's the Morgan Stanley Watch Charts Index. And it's an index of 60 different watches in the grey market, luxury watches by 10 different Swiss brands. And if you look at that now, it peaked in March 2022 and it's been falling ever since. And for the last 10 months, it's been falling month on month. So whereas at the start of all this, when people had these excess savings, you could just, they were going out and buying all of these non-essential items and using this money for non-productive spending. Now you're seeing the complete opposite. And I saw that as the canary in the coal mine when I've been watching these charts and they've been falling year on year out. But then that's just the canary in the coal mine, because if you look further down that line towards where people are actually having to buy things that are essential, of course, we had the massive wave of inflation. And I don't know if you want to get into consumer spending, but we're seeing that massively pull back too. And it's not luxury watches, it's people going out to eat, it's people ordering takeout. It's the kind of things that you see going into a major slowdown. And I think that's where we are now. And I think if they're going to get us out of it again, going back to what happened in 2020 is very instructive, because it will require, in my opinion, not just what they did then, but something even greater, because we're in a far worse situation. And that's the problem with kicking the can down the road. Now, do you think that they can do that without a crisis of some sort? I don't. I think they need justification for it. So again, that's why I think we're in this really precarious spot right now. And the issues around the election and the civil war narrative, I think all of that actually feeds into it because I don't know. I could imagine scenarios where there's some skirmishes that are amplified in the media and they close down businesses again. Maybe they close down all businesses nationally. It would require some event, of course, but I don't know. I'm just projecting out there. It's pure speculation. But I just think if they want to do what they did in 2020, and I think they have to, then it's going to require something big.
Mhm. Before we get to the consumer spending piece and kind of this broader idea of rate cuts and what we're going to see, from now to the election, let's just put a little bit more color on something that you mentioned right at the top there of the last answer, which was this idea of the ballooning of the national debt interest payments. I think adding some context to that, I can't remember what was the figure that you said it's going to be this year for 2024.
This year, they're predicting that it's going to be 892 billion on interest payments alone. So that's not even touching capital, which is the case nowadays.
Which is 153% since 2020. And now it's right at, and this year it's going to exceed the national defense budget. That is astounding to me. So what are the other, let's say, labor force participation rate or even the treasury income? What are some of those pieces that are also pointing in this very negative direction?
Yeah, so there's some interesting charts that you can find on Fred. So one of the ones that I like to look at just because it's such a bizarre chart. And that's one of the things that I would say to listeners too, is just look at how weird. I shouldn't say that because we had a little conversation beforehand where we spoke about how this word weird was being bandied around. But yeah, just look how bizarre some of these charts look. They've got ginormous elephant trunks or ginormous trunks going up in the air. Like they're not normal charts. And I think that's instructive because again, it just shows you in a very visual sense how things are getting more and more skewed and warped out of shape. But if you look at liabilities and capital earning remittances due to the US Treasury, what you find is that ever since 2022, that has collapsed. And that's what the Federal Reserve kicks back based on their profits. But there are no profits. And about 2 years ago, I did an episode where I was basically highlighting how most of the central banks are on paper bankrupt. Now, they can't go bankrupt. It's like Monopoly. The banker can never go bankrupt. He can just make new script out of pieces of paper. And that's what they do essentially on the screen. But again, it's very instructive because if you look at a country like Great Britain, for example, when our central bank suffers a loss, it comes from the taxpayer. The taxpayer has to reimburse the central bank. So the central bank can never lose. Now, in the US, it's not quite the same. But again, who's going to be the buyer of US debt when they're watching this dynamic play out year in, year out? And just going back to some of the other things that you was discussing, Tom, the US defense one is absolutely wild to me because the US spends more on defense than the next top 10 nations in terms of defense spending. So that just puts it into context just how huge it is. And again, where's that money going to come from? Who's going to be footing the bill for those interest payments? Well, it's going to be the US citizen. Now, the US citizen is actually in dire straits right now. We've got record levels of credit card debt. Delinquencies are shooting up on auto loans and credit cards. There's a lot of data that we could look to as well. So if you look at, for example, household discretionary spending, I mentioned that people are eating out less, which is a really good indicator as to what's happening in the real economy. Mm-hmm. We can look at earnings of companies like Nvidia or Amazon and get this kind of Wall Street view. Excuse me. But I like to look at what's actually happening in the real economy because a lot of those pieces of data that they give us, I think they can quite easily cook the books on. And you know this because they actually revise data 2 years, 3 years down the line. You'll get an alert on the website and it says, oh, we've revised data from 3 years ago. And you're thinking, well, what use is that now? So I always try to look at actual boots on the ground stuff. And in terms of the real economy, if you look at the National Restaurant Association's performance index, which is a good indicator to look at, it's been contracting all year, including during summer. So month on month, it's contracting. Now, normally over summer, you'll see an uplift in that data because people go out. It's sunny, it's a good time to go out and eat with family, but people are not doing that. And when polled, the majority of restaurant owners say that they don't think it's going to improve in the next 12 months. So if you think about the knock-on consequences of things like that, of course, they're going to be preparing their budgets for next year. They're going to be thinking about employee numbers, and they're going to start to lay people off. They're going to start to get rid of staff because they're expecting a recession. And that's coming from their real experience. It's not coming from data from the Fed. It's not coming from announcements in the financial media. Of course, we've also got a lot of businesses that are indebted and at much higher rates because of the interest rate rises. So that's another factor that I think is going to weigh heavily on the economy going into that first year of the next presidency. And I don't want to sound like a doom-monger here, Tom. It sounds like all negative information. And there are definitely counter narratives too. But personally, I don't think they hold much weight. I think what we've seen is an artificial boom over the past few years that was purely based on that amount of liquidity that was pushed into the system. And now we're on the other side of that. We're seeing a glut. And it's the same in Europe. Like if you look at European businesses, there's huge layoffs this year. Nokia, which is responsible for the 5G rollout across Europe, they announced 14,000 job cuts, which is almost 20% of its workforce. Ericsson, which is a competitor to Nokia, they've laid off around 9,000 employees. Maersk, which is a giant shipping and logistics company, they've reduced 10,000 jobs at the end of 2023. So this, to me, again, it's information saying that the companies that employ economists, they're expecting slowdowns as well. And what we're going to see is that start to feed back into jobs and employment. And I think in Europe, the messages that I'm getting from people is that already is happening. I know numerous people that were employed by corporations who are being told that their job might be on the line, or they've already been laid off and now they're freelancing or trying to work independently. But in the US, where a lot of people hang on to this official data in terms of jobs, which is turning downwards now. But I would say actually that's probably not the place to look if you want to be ahead of this one, because usually that data is retrospective rather than prospective, looking forwards. So I'll hand it back over to you, Tom, because I feel like I've probably answered 4 questions there instead of 1.
No, it's great. We always seem to have a good synergy and end up kind of covering a lot more just by exploring these topics. But I want to go to this idea that you were kind of saying about saving the system. Jerome Powell recently came out at the Jackson Hole Fed meeting with very strong dovish language, really setting the table for a September rate cut. So let's talk through this idea of, getting back on this rate cutting cycle and how this ends up, maybe playing into affecting the election one way or another, and or what this means for the markets as well at this time.
Yeah, I think it's really interesting timing because normally the Fed would not seek to do rate cuts this close to a presidential election because, of course, they can be accused of trying to influence the result. Now, in terms of what Powell actually said, I think we have to be careful because, it's kind of like a voodoo or astrology. People look at what Jerome Powell says and the way he said it and what did his face look like when he said it. I always joke that people would do interpretations on the way Jerome Powell farts because the financial media is just so obsessed with trying to get ahead of what the Fed's going to do. But ultimately, let's look at what he said. He said, the time has come for policy to adjust. The direction of travel is clear. Timing and pace of rate cuts will depend on incoming data, and we will continue to support a strong labour market. Now, for me, the most important part of that was the last part, support a strong labour market, because that suggests to me that he and the Federal Reserve, should I say, are aware of some of this stuff that we're talking about, some of this data that's coming in that suggests the labour market is weakening and people are tapped out financially. Like I said, that 2.1 trillion that was given to people over the COVID stimulus period, it's all gone and they're in a worse position than there was in 2020. So if things were getting bad going into 2019, they're in a worse financial situation now and debt levels are higher and credit card debt's higher. So when it comes to the rate cuts at this point, is he actually going to go ahead with it, or is it actually going to be a rug pull moment where he doesn't? And that feeds back into this conflict narrative that we have around the election. I'm not so sure. I mean, I always try and be speculative in the way I think, because I think it's best to have different ideas laid on the table rather than just to assume that what people in the financial media are saying is going to happen, because I could see how that could actually be useful too, for them not to raise rates. Having said that, would they have enough time then to recover if they didn't raise rates in September, in let's say October or November or
cut
after the
rates.
election? Go ahead, Tom.
Cut rates, right? You said raise
Sorry,
rates.
cut rates. Yeah.
Yeah.
Yeah, cut rates. Probably they probably could leave it a month or so, in my opinion, because we're going into autumn, winter anyway. So I'd say the worst period's out of the way for them. If they do cut rates, then yeah, it would normally help the incumbent president. And I mean, it could be Biden, or maybe it's going to be Kamala Harris by then. We don't know. It's such a mess what's happening in the US right now. And I think if you look at how past rate cuts have gone, most of the time, like let's go back to 2008, the Federal Reserve was already cutting rates going into the GFC. So just because they're cutting rates, it doesn't necessarily mean it's going to bail out the system. I mean, to cut rates to the degree that I think they would have to, I think they'd have to roll it all back, Tom. I don't think it's going to be effective for a half percent or 50 basis point cut. I don't think that's going to be enough, my friend. I think they're going to have to roll it all the way back. And that's going to take time, unless there's a crisis in which they could do multiple rate cuts in a month. So I'm prepared for rate cuts, and I think gold's going to be the obvious winner in all of that. The stock market will get an initial boost, but whether that's going to be something that's actually going to be lasting more than, let's say, a few months, I don't know about that. Historically, it's not always the case. And like I said, when they cut rates going into the GFC, it wasn't enough just to cut rates. It needed a whole wave of stimulus also on top of that. That's what they needed to do going into 2020 as well. So at the end of 2020, when they brought across, it wasn't just rate cuts that was needed. It was this massive wave of stimulus also. There was all of this fiscal spending and, of course, the helicopter money. So I think rate cuts by themselves, it's not enough, Tom. And I don't want to say they're unimportant. They're going to be important, but they're not going to work by themselves. It goes back to BlackRock's white paper. There's going to have to be new monetary stimulus added. And I think with that, we'll probably... it will precipitate more crisis too, although it will necessitate more crisis. People will, I'm not sure what that's going to look like, but I just think we have to be careful in how much weight we put into these interest rate cuts. They'll have to roll it entirely back, and there'll also need to be additional monetary tools used on top of that. And I think it's going to go back to, essentially, you could call it deficit spending. It's just printing money and throwing it into people's bank accounts so that they can go out and spend it. But as we've seen, there's a consequence for that. You're kicking the can down the road, you're going to get inflation back, and the inflation, as BlackRock's white paper said, could eventually become hyperinflationary. That's not a tool you want to be using. Maybe you could get away with it once, but for that to become your dominant monetary policy tool, that's extremely dangerous. And again, I just think this feeds back into the notion that maybe something different will happen this time. Maybe not this time round. Maybe we have another go round this whole pantomime. It really is what it is, Tom, because it's an illusion that we're going to fix something. It's an illusion that this is just a temporary crisis. We'll get over it and then we'll go back to business as usual. Well, clearly that's not the case. It hasn't been the case since 2008. So therefore, maybe something else will happen at some point. Maybe they will have to have some more coordinated and maybe even a global reset of sorts. And I err on that side of things. And I know it's a controversial take for a lot of people, but I do think that's where we end up.
Yeah, I mean, of course, it's impossible to put a timeline on something like that, but the end game for this system, I think, is the end has to be coming. But I wanted to kind of make an analogy or a metaphor for, as you're describing this interest rate and stimulus cycle. It's almost like a pendulum that is actually gaining speed and gaining momentum each way every time it swings, rather than bleeding it off as a normal pendulum would with friction and how things actually work in the real world. We have to get tighter and higher for longer, and then when it swings back the other way, precipitated by whatever crisis, we end up cutting faster and using more stimulus than ever before. And it seems to be this cycle back and forth that's getting more extreme every time we do it. Of course, we we've all heard and understand the lags with which rate hikes and even rate cuts work through the system in. So let's touch on, if you wouldn't mind, Mike, this idea of how the bank's balance sheets are actually sitting when we consider the higher interest rates and what those have actually done to the bank's balance sheets if they were actually marked to market.
Yeah, so basically, because of the higher interest rates, it's decimated the banking sector. But of course, because they're not being marked to market, and the banks are able to keep that essentially tucked away, there's no immediate consequences from that. But there is also no route to fixing that. There's no route to fixing it, and the only way that I could see that they might recuperate some of those losses and shore up the balance sheet would be probably to buy back in at much lower interest rates and then hold those bonds. And maybe the value of their previous bonds will have some kind of uplift at that point. But again, it's, what we're talking about here, Tom, is constantly trying to come up with a new magician's trick to fix the problem. And I don't think that's a stable financial system. I don't think that's a route forward. I don't think it's a healthy monetary system where you have to always come up with a new trick, a new accounting fraud, a new illusion, because that's all it is right now, of course. I mean, the financial media has to keep people believing in the system too, because that's a big risk, is if people lose their faith, and that could, in and of itself, spell the end of the system. But I would argue that if you go back to 2000, Tom, really the system as we know it was permanently wounded there. I think it was catastrophically wounded in the year 2000. I think you see that if you look at the financial markets from year 2000 onwards and the major indexes versus gold over the last 30 years, that's when you've really seen that most of the returns that we've been getting in the financial markets are nominal returns. And a lot of that's coming from currency debasement, and gold's telling us that. But yeah, in terms of commercial banking, I think it's just going to continue to get. Basically, it's going to be bigger banks eating smaller banks, as smaller banks can no longer keep up pace. It's like an ultramarathon, Tom, but nobody gets to the end. At some point, everyone collapses, but the smaller ones are going to collapse first. Those guys are going to go. They'll get consumed by the bigger ones. And then at some point, I imagine, if I was putting my speculative hat on again, that there will be some kind of consolidation amongst the SIFIs, the systemically important financial institutions or banks. They'll be the ones that remain, and it will be a selection process. It won't, you might think your bank's fantastic and you might really like their ethos, be a co-op, but ultimately, sadly, the safest banks will probably be the ones that get given the nod and told that no matter how bad you get. I mean, look at Deutsche Bank. It's a terrible bank. They've been involved in all kinds of scandals throughout their history, including during World War II. They was supporting the Nazis. However, it doesn't matter how good a bank is. It doesn't matter what they've done. What matters is that bank going to be saved or not in a crisis, or are they going to be told you have to combine yourself with, like Credit Suisse did, so with their UBS in Switzerland. I think we'll see more of that in the coming years.
Mm-hmm. So let's go to, I don't know, maybe the types of solutions we see for this. This does seem like, maybe there's only a couple cycles left that we can swing this pendulum, but what does gold typically do in a rate cutting cycle? And why do you see it as such a valuable asset to really bridge value from one system to another?
Yeah, usually gold has a fantastic year after the year of rate cuts. So the year afterwards, what you'll often see is gold will double its long-term average. So around 8-9%, let's say, in the dollar. In currencies like from the country I'm in, it's more closer to 11%. Usually you'll see gold double that. But what's really fascinating to me, Tom, is that despite the rate increases, which is usually when you see gold fail to catch a bid because people cycle out of gold because it doesn't give a yield. They'll go into bonds. If a bond gives them 5-6%, they'll say, right, I'm going to take that over just the year on year in appreciation of gold. That hasn't happened. Gold's at an all-time high. And every time we've seen a little bit of weakness in the gold price, it's immediately been bought up. So that to me is very instructive. It's the same with gold seasonality. Normally over summer, we have a very weak period for gold. That hasn't happened too. So all of these headwinds that we're used to seeing in gold no longer matter. And I think, again, what does that mean? Well, I think it means people are seriously losing confidence in this system and the currencies. And I think the biggest players out there, and we could class China, the nation, as one of the biggest players. I think they've been setting up for this for a long time. They're never going to come out and say that we're setting up for a failing financial system. They're always going to talk about reform, talk about having some kind of global treaties with different countries. But ultimately, I think they foresaw this a long time ago. They saw it in 2008. That's why they had the white paper in 2009 from the central bank, written in English, talking about some kind of systemic reform, which never happened. The year after that, they started to advise their citizens to buy gold, having essentially outlawed the ownership of gold for a long time, or the purchase of it. And of course, we know they've massively increased their own holdings. Russia's done the same. So you're seeing nations get set up. And I think as citizens, there's actually not much downside to owning physical gold. And there hasn't been for a long time. Over the past 50 years, it's averaged in the dollar around 9%. And that's going all the way back to 1971 when the peg with the dollar was broken by Nixon. So there's not a huge loss there. And even if you look at the gains over that time, there's been a lot of money flooded into the stock market over the past 50 years. There's been many cycles of quantitative easing, many manipulations that they've achieved, but gold's still done around 6,300% over that time compared to 5,700% in the stock market. So you could essentially just have bought gold and gone away. Now, I know some people like to make their strategies more complex. I do myself. But actually, if you look at where we've been since the year 2000, that's the most instructive, because with the dot-com crash, no market really recovered from that. If you go back and look at the Nikkei index, for example, that's been up around 120%. It's only just achieved its old all-time high, nominally speaking, the past year. But from the year 2000, it's gone up 120% over 30 years. If you look at gold in the Japanese yen, it's up 1,000%. 1,000% in the same period. And over the past 4 years, it's up 100%. So we're in that stage now where the currencies are devaluing so thick and fast that it's very hard to hide that. You can't suppress the gold price, even though they've got mechanisms to do that. It's very difficult to do that in this environment now. You can look at the FTSE 100. I don't know if many of the listeners know this, but this one's even more shocking than the Nikkei. The FTSE 100 from the year 2000 to today is up 25%, Tom. 25% in 30 years. Gold in the British pound is up around 950%. So, people who had remember people had their pensions invested in those markets. My pension fund when I was in the UK was roaring with the FTSE 100. Thank God I didn't invest myself psychologically in that pension, expecting that I was going to receive it. The same with the S&P 500. The S&P 500 is the premier stock market, but even since the year 2000, with all of the financial manipulation, the quantitative easing, the helicopter money, is up around 380%. Gold's up around 804%. So this, to me, is very instructive also, because it shows people that what's actually happening is they're debasing the currency to keep these bubbles inflated. And gold's telling us that. It's showing us that these aren't real gains. The economies are not growing. What's happening is they're just debasing the currency, and that's speeding up now. Gold in the British pound has doubled over the past 3 or 4 years as well. That's a lot, Tom, in 4 years. And if you look at gold's returns for this year, it's around 25% in most currencies. And that's during interest rate hiking cycles. What's going to happen when they start to cut those rates and cut them fast? And then, of course, they're going to need some kind of fiscal stimulus to go with that to get the economies kickstarted for another year or whatever it's going to be before we end up exactly in the same place where we are now. So that's why I think gold's such a good protection. I'm sure 2,300 years ago, they could not have foreseen a time when we had derivatives, or we had the threat of cyber attacks, or any of these things that we sometimes discuss. And yet the answer was the same then as it is now. It's always worked. It's always protected people from these moments in history where there's threats of confiscation, there's threats of financial catastrophe, there's lack of trust in the system. And like I said, it's kind of a simple answer. It's a no-brainer, simple answer. If you was in gold over the past 10 years, you've done well. You've done fine. And because of that, you also now have some money to speculate with too. And I think for us, the people who are listening to this, in terms of the gold and silver miners, there's great opportunities ahead there as well. Now, I wouldn't say buy and hold them throughout this period, but I would say if you understand the cycle, if you understand the dynamics of liquidity, particularly with junior and mid-tier miners who are very small in terms of their market caps and how that liquidity affects them, on the downside and on the upside, there's going to be some great opportunities, particularly if your wealth foundation all along has been gold, because you've seen those steady gains. You've not had to take on any real risk for it. And now you've got some extra profits that you can cycle back into this system, because even as it's dying, Tom, there's going to be great opportunities. In fact, those are the biggest opportunities, I think, as systems get to these more volatile periods where you're going to see these big swings. And also, there is one part of it as well, which is quite advantageous, which is to understand that if they have no choice but to try and save it, well, you can kind of guarantee they're going to pump it back up with liquidity. So if you see the market's down 20, 30% and gold and silver miners are down 50, 60, 80, 90%, as they are wont to do, well, you could speculate a little bit there and see some great returns in a very short space of time as that liquidity comes back in. But I think it always, for me, comes down to wealth preservation first and foremost, and having, if you imagine a wealth pyramid, the base of it should be physical metals, particularly gold, because we know that's what a lot of nations are going to be turning to. Also, that's why central banks are buying a ton of gold. That's why China's been hoarding it for the last decade. So the writing's on the wall, Tom. The answers are surprisingly simple. We can mess it up if we get too complex. So definitely buyer beware and think wealth preservation first and foremost. But on top of that, listen to smart people like you and the guests that you have on, and maybe you'll be able to increase those ounces going into whatever the future is, Tom. Maybe it doesn't go the way we think, but you'll never feel bad for having preserved your wealth. It's always a good thing. Mm-hmm. And, if you can increase those ounces a little bit along the way without getting too risky, I think that's the way forward from here on out.
Yeah, I mean, you make a great point of this idea of tangible wealth with ideally no counterparty risk, I think, is, as you say, the base of the pyramid. And then we can complicate things and get riskier from there. But as we think about this idea of risk, you recently talked about this idea of the riskiest assets during these times of extreme liquidity dragging the market higher. So what are some examples of that? And is this starting to show us this rollover as well when we think about these extreme concentrations in wealth, like Nvidia, for example?
Yeah, it's hard to use a traditional paradigm in terms of value investing in today's world, because it's been shown so much that people have normalized the abnormal. So you can have companies that are trading at price to earnings multiples or price to free cash flow multiples that are just obscene, things that we've never seen before. And there's always, a CNBC commentator or a Jim Cramer coming along to tell us why that's okay and why we shouldn't care about valuations in the traditional sense. But if you look at the stock market, it really has just been 7 companies. Nvidia has made up a substantial portion of that. And that's because, of course, the S&P 500 is so weighted. So it's weighted towards these massive companies. I think they make up around 30%, the top 7 companies. Excuse me. So that's really, I think that concentrates risk as much as anything, because it means that if there is a downturn and people rush out of the riskiest assets, which is what they often do, that's usually the first to fall. So it'll be cryptos, it'll be Bitcoin, and it'll be tech stocks. It'll be anything that's heavily over leveraged and can't refinance easily. Those are the spaces where we'll see liquidity drain. But of course, that has that effect of pulling down the markets in general. If the index is falling, then you get the algorithm starting to kick in and they start to sell. And before you know it, you can be down 30, 40%. Now, of course, they can just stop people selling. They did that the other week when the yen carry trade started to blow up. There was about a dozen, I think, different trading platforms and brokerage firms that all of a sudden their platforms went dark and people just couldn't sell. The same thing happened during the Ukraine-Russia conflict when that first begun. You had a great guest on who said, I couldn't access my platform. I just couldn't sell. And there are such things as a freeze or a lock. The DTCC talk about this on the website. They can literally freeze a single company or the entire market. They can just freeze you out and you can't sell. Those are the things that I worry about, Tom. When that concentration is in just 7 companies, and Granted, we've seen some more breadth in the market recently, but ultimately, I would say if you see those companies start to fall, it's only a matter of time before the rest of the market comes down with it. And I'm not somebody who believes there's going to be a huge rotation into value stocks. I don't see that happening. What I think is going to happen is they're going to continue to pump the Ponzi assets, as I like to call them. And when they fall, they're going to reflate them or try to reflate them, but that's going to come at the expense of the currencies. So I think that's the dynamic that's going to happen. It doesn't mean those are the stocks that I would personally be in. I prefer value stocks. I think there's still great opportunities to be had in them, particularly in sectors like, for example, copper, iron, nickel, uranium, because even after they've pumped up these asset prices, what you saw, the dynamic that I saw anyways over 2020 to 2024, is you had this initial wave of liquidity rush back into those stocks, the commodity producers. But then when the inflation came, they had a second cycle that came just after that. So you could buy in the first cycle, sell, some of those stocks, for example, Mosaic, one of the biggest fertilizer companies on earth, that was up almost 1,500%. That's huge for a company of that size. And that's because of that liquidity dynamic of liquidity being drained out of the stock and then rushing back into it. But then there was money cycles after that. The same with Vale, which is the world's largest iron producer, which is pretty beat up right now because of this slowdown in the commodity sector. So those are instructive as well. Look back at what happened with 2020, see how the dynamic plays out, and I anticipate it will look something similar. Inflation-sensitive assets or companies are really good to be in because you'll get multiple cycles. It won't just be the first wave of liquidity. You'll get that hit of inflation too that drives people into these stocks out of panic. But ultimately, yeah, I think the name of the game is just to keep kicking the can, keep the roulette wheel spinning until at some point, Tom, I think the cashier closes shop. And if you've got the chips from the casino, they're not worth anything at that point. That's the problem. That's where gold comes in. Gold is worth something once the casino closes. But if you don't take your chips and cash them in before the end of it, then yeah, you're going to get stuck and you'll probably be on the losing side of it. So that's why I err towards assets that I think are most likely to survive whatever happens. And yeah, I speculate too, like anyone in mining stocks. I love the mining sector. I love nothing more than to research a company and to do the valuations, as I'm sure you do. It's part of what we enjoy. But even then, I think the risks are getting higher to be buying hold. Like if you're buying and holding anything, what's your timeline? 10 years, 5 years. It's hard for me to project that far out right now. So I brought my time frames down in terms of investing.
Mm-hmm. Yeah, I think an important thing to mention there is just that we're not speaking in absolutes, right? You have this base of your pyramid, and then you have speculations here and there with a time frame associated with it to understand the risks involved as well. And I think to just say, okay, well, you have to take everything off the table and go all to cash or all to physical gold, that's absolutely not what we're saying. And I think to add a little bit more color to that, I think that's important.
Yeah, I agree, Tom. I've said this many times the last few years. The problem with that strategy is, okay, you could have gone straight to just sitting gold, but there's still risk there. There's always risks. And I think if you want to be a good investor, your job is to find the risks when they're hidden. It's what are the hidden risks there? With gold, there's all kinds of things that could go wrong. There's outside risks, that are very low probability, but could still happen. Theft, fire. If you've got it in a vault, maybe something happens at the vault. Maybe you can't access it. Who knows? There's all kinds of things I could imagine. Similarly, maybe there's a confiscation. Maybe there's some kind of issue globally, and they say in the West, right? Well, China's got all of this gold now. They've just revealed how much they've got. We need the gold. Be a patriot, Tom, and hand over all of your gold. Who knows? And of course, people might say, well, it's low probability, but that's the point. Just because something's low probability, it doesn't mean you ignore it in your risk analysis. So to be so concentrated in any one thing is not a great idea, but I do believe as things get more extreme, your portfolio will probably look more extreme. You'll be naturally heading towards more safe assets, and there's only so many that people can buy, and gold's a perfect one. So I'm all about that, but then I also think it makes sense to have some money there to speculate with too. It might be 10% of your portfolio, Tom, but like I said, if you'd have bought some of those junior and mid-tier miners at the bottom in, say, April 2020, then they were up 100, 200% within about 4 or 5 months. Well, you could have bought yourself a lot more ounces because of that, and you didn't have to take much risk because they were trading at multiples that were extremely low. And this was even after the Fed had stepped in and said we're gonna bail the system out on that weekend. I think it was in April. Also, silver dropped to around $10 per ounce. Understanding that dynamic around silver is really important as well. That silver trades like an industrial metal. So if we have a big global slowdown, silver does collapse. And then what you'll see, of course, is it will quickly go back up because the miners ain't going to be producing silver at $10 an ounce. And if you try to buy silver at $10 an ounce in a crash, no one's going to sell you it, but you can buy miners still. So again, you can take advantage of those opportunities. And it's a very safe strategy because essentially you're sat on the sidelines, you've got a position, you're just not deciding to be in the market 100% of the time. You're being more strategic. You're using the information. And I would say most people listening to this have a much higher acumen for the markets than the average portfolio manager because they are invested all the time. They don't actually respond to the world as it changes. But you can do that, and gold's still rewarding you. If you're sat in gold, you're getting 25% a year. Okay, well, maybe you can take 10% of those gains and actually have them sat there ready to deploy in the market when you see this scenario. Now, maybe the scenario comes and you change your mind, but that's fine. At least it's better than being sat in cash or being sat in bonds, in my opinion, which have the counterparty risk. But yeah, I'm like you, Tom. I don't think it's a good idea to be completely out of the markets all the time unless you're waiting for an opportunity. Then that makes sense to be out. But there's still other real assets you can invest in as well. There's always opportunities out there, in my opinion. It's just bunker mentality, right? You can do it as an investor or you could do it practically. And I always say, after 2008, I'm sure a lot of people went completely to gold and just sat there and they bought gold at $1,800 an ounce. And then 15 years later, they probably hate gold. You know what I mean? And that's one of the risks of being in gold at the wrong time. If you buy something at a cyclical high, it's always a bad idea. People like ourselves have probably bought gold back when it was, half the price. So right now you're sat there with enough cushion to actually have some confidence speculating. You're not going to be so worried about it. For people that are maybe, people that have been in, let's say, the sharp end of the markets, and the gains have all been because of liquidity, and they've been riding that roller coaster of ups and downs. Maybe they're investing for the long term and they're not actually taking money out or profits on the way up. Then that's different. Yeah, those people are probably getting a bit frightened right now. And yeah, it's harder to buy gold when it's at an all-time high than it, I remember the first time I bought an ounce of gold, we was debating whether $900 or $1,000 was too much for an ounce, and then you laugh at yourself years later. You say, wow, I wish I'd have bought more back then. So That's always the case with an asset like gold. But of course, I think it's wise to not rush into anything. So if you don't own much gold right now, I'd say, cost average.
Mm-hmm. Mike, I'd like to kind of wrap up talking about a little bit of contrast in a way. I find these examples always very instructive. So to really, let's say, show the differences between the US and this narrative that's being pushed, how is Russia doing right now? How is their economy doing? How is their population doing? What metrics can we look at to see how the country itself is doing since the start of the war nearly 2.5 years ago now?
Yeah, it's interesting. I live quite close to Russia, and I've got a few friends or people that I've interviewed for my podcast who actually have connections to Russia, people who are also involved in finance too. So I ask them regularly about how it is on the ground, and then I also try and keep abreast of what's happening in terms of the fiscal situation over there. In terms of the economy, Tom, it's actually been positive for the economy. The poorest regions of Russia now have the highest levels of savings that have ever been recorded. So these are the so-called forgotten regions of Russia. So it's the industrial heartland where it's lots of low-paid minimum wage workers. Well, they're actually being paid double, triple, quadruple what they would normally earn for joining the military or signing up for service. So there's a lot of people in those regions who are actually seeing an increased economic strength in their families. Also, if a person actually falls in the war, I think it's 50,000 US dollars that Russia pays out. And it's a terrible way to look at things, but I'm speaking dispassionately because we're talking just about the finance. And again, if you're looking at a region where the average salary is about $400, $300 a month, $50,000 is a lot, if that gets paid out to a family. So what Russia's actually seeing in terms of its economy is being a boom. It's actually been positive for the economy. In terms of how people are responding on the ground, of course, when a country is at war, and this war has been particularly difficult because it's led to all kinds of consequences, let's say in the West, where people have, Russian athletes have been banned from competition. And I'm a fan of classical music, but there was a time where everywhere refused to play Tchaikovsky, which, this is the kind of insanity that we've been seeing, which is a part of this propaganda machine. But there is an index out there as well, which is quite informative that I found. It's called the Misery Index. And this is where they analyze the cost of living in a country, inflation, savings, and they basically put it all together to find out how a country is doing or how bad it's doing, which is why it's called the Misery Index. And what was really fascinating was Russia scored better than ever before. It was in July, I think. Better than ever before, meaning that by the metrics alone, they're doing better than ever before. Of course, for individuals' lives who are at war, that's different. But and what was interesting also was Ukraine scored the worst they've ever scored on that. And what was even more interesting to me is Russia are scoring better than Europe, mainland Europe, and Britain, and it was only 1 point beneath the US. Now, I can vouch for that because I know a lot of people across Europe, and I know how people are struggling, particularly in countries like Britain. So in terms of, is this war damaging Russia? In some ways, I think it is, but I would also say it's actually being advantageous in other ways. And it is driving their economy, and that's why they're bucking the trend in terms of the economic slowdown that we're seeing in a lot of other countries.
Yeah, I mean, trying to get an accurate picture of what's going on, not even in your own country, but in the world, I think is sometimes difficult. And speaking to people and actually getting, a hopefully objective data point like the Misery Index, always quite interesting. Mike, as we wrap up here, is there anything that you'd like to leave our listeners to think about or to keep in mind over the next little while here?
Yeah, one thing that I would probably leave on, Tom, is something that we often talk about off air, which is just understanding that when it comes to investing, the best investments you can make are actually not financial ones. It's in your health, it's in your peace of mind, it's in your family and your relationships and your community. And there's so much that's going to happen in the coming year or so that's going to try and drag people away from all of those things. But one of the great things about gold, which we touched upon in today's episode, is its simplicity. It allows you space because you know that it's a safe investment. You don't have to be tuned into every single narrative, which are going to be fear-based. You don't have to care about every single political decision. It's going to protect your wealth over the long term. It's going to give you space to actually go out and do those things that you care about. You don't have to watch screens all the time. Yes, there are opportunities in the markets, but the great thing about gold, Tom, is that simplicity. It makes your life more simple. It protects your wealth. If you want to invest, you can do, but you don't have to necessarily be in the market all the time, which gives you space to go out and do the things that actually really matter. And I would say that is investing to me. Every day I invest. I invest in my health. I invest in my family, or at least I try to. And I think if you have that perspective, it will be very healthy going forwards when actually, financially speaking, maybe you don't want to be investing too much in some of these markets. Or if you do, it's going to be at a reduced level to before. So there's many ways to invest, Tom. It's not just financial.
That was really, really well put, Mike, and I appreciate that perspective and the way that you worded that was excellent. Of course, for anybody that would like to hear more from Mike, Parallel Systems Podcast on YouTube, as well as on Twitter, parallel_Mike, puts out lots of great content and some really interesting guests. And of course, you're one of the first ones that highlighted the risk, like the great taking. So really on the cutting edge of a lot of this stuff. Mike, I want to thank you so much for coming on again and sharing your knowledge with us.
Yeah, as always, Tom, it's a great pleasure. I always enjoy our chats, so thank you.
Thank you. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.